Hello, Dream Builders, and welcome to the Home Ownership Intensive with Nativa, the Frugal Creditista. This is day number 2, and we are going to dive into qualifying income. Employment, income, and credit are seriously the top 3 factors that a lender considers when approving you for a home loan. And income is more important than all 3 because you can have relatively challenged credit, and as long as you are employed and have a decent income, you can get approved for a home loan. However, you can have a perfect 850 credit score, but without income and employment, you will not be getting a mortgage anytime soon, okay, until that actually happens. So I wanted to go over a few things that a mortgage lender looks at when they are looking at your income. So a lot of people think that just because they have their paycheck stubs, their bank statements, and their tax form, that a lender is just going to consider solely that when qualifying them for a mortgage, and that's simply not true. There are some things that'll cause them to start making some deductions or subtractions away from your income that they're going to use when qualifying you for a mortgage, and I just wanted to go over a few of those with you. So if you are a W-2, basically a full-time employee, and full-time in the mortgage realm is usually 30 hours plus, then they are going to look at your gross income. And that's why they're collecting usually the 30 days worth of paycheck stubs. They are collecting your tax returns, and they're collecting your bank statements to determine that. And they're going to take the gross monthly amount to determine how much of a mortgage you can afford per month. Now, if you are an individual that has part-time income, you receive overtime or bonuses, then your process is going to be a little bit different because they are going to request more documentation. What they are looking for is how often you've gotten this and how consistently, okay, or how you get paid basically. And so when you have a part-time job or a bonuses that you receive on a regular basis or commission that you receive every now and then, or even overtime, they want documentation that 1, it's going to continue, and 2, how often or how long have you been receiving it. Usually the magic number in the mortgage realm is 2 years. But that's like the minimum, okay? So it's like 2 years plus. Basically what I mean by that is that one lender can say, okay, we're totally fine with 2 years. Another lender would say, we probably want about 3. We feel more comfortable with about three years or so. And what that means is that you want to provide them with that documentation. It can be more of your paycheck stub submitted, more of your deposit slips or bank statements showing that you've been getting this over a consistent basis, or, which is what I had my clients do, submit documentation from the employer, and they literally can submit a letter or a full accounting of how much you've received for the entire year. And what a lender is going to go in and do is then average that out so they can get a consistent number that they can utilize when determining your debt to income ratios and how much of a home loan or a mortgage you can afford. So a few of you asked about Social Security, pension, and disability income. That is totally acceptable. What I have found with some of my own personal buyers, though, is that they don't receive too much, unfortunately. And so it's not that you can't be approved or you can't qualify for a mortgage. It's just that the amount that you're receiving limits how much of your home loan. It limits the amount that you're approved for. That means that you want to be more open to location so that you can find properties that align with how much you can afford. And there are some other variations as well. When we do our Q&A with our loan officer, you can totally delve in on them and ask some more questions if that's applicable to you. But just know that if you are on a fixed income, you can definitely get approved for a home loan. And there are some little adjustments that can be made if you pay taxes on it or not. And as I mentioned, we can definitely take a deep dive on that with a live Q&A so you can get your own personal questions answered on that. A few of you had some questions on if you receive child support and alimony. They can also totally be used in qualifying you for a mortgage. So you'll have your income and then you'll have that alimony and child support that's also factored in. What a lender is going to look at in that case, how long have you been receiving it? Will you continue to receive it? That means that you're going to have some documentation from the courts stating that, okay, yes, she's been currently making boom, 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 this. You also remember, have your bank statements to prove that as well, plus the court letter. But they also want to know how long will you continue to receive it. If you're only going to be receiving it towards the end of the year that you're looking to get a home for, no, it's not going to be included. However, if you have a 3-year-old and you're going to be receiving it for the next, what is it, 18 now? I should have did 2 years. 2 years old, you're going to be receiving it for the next 16 years, then you're totally fine because you're going to be receiving it for a while. And if you consider everything that I went over, lenders are looking at income from like 2 years, maybe three, some even four, depending on how much you're getting approved for. And they're basing a 30-year loan off of that short time frame. So you want to come correct. When you come into a mortgage loan officer's office, you want to have all that documentation down. And I'm telling you, when it gets to the underwriter's office and you happen to be one of those individuals who has a part-time job, who has receiving child support on a consistent basis, who has commission and bonuses that they're receiving on a consistent basis, come with some documentation from the actual employer, because a regular wage to earner who makes the same amount every week, every 2 weeks, every month, however often you get paid, those are at a risk level right here, right? But once you start adding, this is my base and this is my commission and it goes like this, what is a lender thinking? A 30-year loan. This is risky. You're going to have to give me something. So any type of documentation that you can provide in the form of paycheck stubs, bank statements, taxes, and back it up with any documentation that you can get from your payroll office / HR, do it. Absolutely do it. And I can tell you, if you're one of those individuals who has that part-time OT, commission, bonuses, etc., you want to prepare your employer for receiving a verification of employment phone call. Yes, an underwriter will definitely make the phone call to verify that you're receiving this and how long you will continue to do so. So that's why I automatically have my clients, my buyers, get that in the form of a letter. And then when they call, it's just, okay, you stated this, this, and this. We're just verifying that it's still true and nothing has changed. It makes it so much easier. Otherwise, what will happen, and some of the buyers and the dream builders, some of the dream builders here can definitely attest to that, you'll be submitting documentation back and forth, back and forth, back and forth, and it freaks you out. It makes the entire process more stressful. Prepare from jump. Get this information from jump. Now let's go over to my self-employed individuals. Your process is going to be stressful anyway. Why? You're self-employed, and unless you have had your business for a while and have been filling out your taxes properly, then most of my business owners do not. That's why I preface this. Then you're going to have a pretty stressful purchase. So I would just say, just prepare for this. So I actually had a list, and I'll put this in a course of what you need to do in order to make this a smoother process for yourself. Number one, you want 2 years of seasoning. You'll hear that word a lot in the mortgage. That basically means that it's regular, it's consistent, and it's 2 years plus. But you want 2 years of documented tax returns. No cash anywhere is allowed, whether you're a all cash employee, whether you are a self-employed person. It's IRS income only. That's why those taxes are so necessary. The issue that most of my business owners have is that they write off everything. You cannot do that when you are looking to purchase a home, because a lender isn't going to look at your gross like they do a W-2 wage earner. They're going to look at what you said you actually made after you've deducted out all of your expenses. And they want that to be consistent over 2 years. And I'll be real with you, most of my lenders want about 3. But 2 years, you can still find a good lender, okay? They want to see if the income is similar. Basically, they're looking for, is there a wide gap? Remember that inconsistent income is risk, and lenders aren't too keen on that. They want to see if your income has declined at all from the previous year or years. So they don't typically mind when your income is going up, right? But when it starts to go down, that's a red light. And that actually is applicable to W-2 wage earners too, but even more for my business owners. So if you are having declining income, I will put home ownership off for a little bit, and I will perhaps think about ways that you can create that consistent income. Get it with a business coach. We got some in the group, I'm sure. But you want to make sure that your income is steadily increasing, is consistent. So basically, your accounting has to be on point. I've had business owners who've had to submit statements from their CPA or tax preparer just to make sure, or kind of calm the nerves of the loan officer that's lending to them. I also wanted to bring out declining income just because I mentioned it. And I noticed that a lot of my W-2 wage earners, employees, have that experience too. So I kind of wrote up a little bit here, and I'll actually put it up in a write-up of how declining income affects your mortgage approval. So if your income was less 1 year, so let's say since it's 2017, 2015, but then it's more in 2016, then there's no issue. Your income is going up. Remember I said that for business owners, the same with you. If your income's going up, They're happy. Okay, good. They're making some money, right? However, if your income is less 2016 than it was in 2015, then they're going to use the lesser income. So 2015 becomes a wash if that was your biggest year. It's now 2016's income, and they're going to divide that income by 12. So they're going to take the whole year's income divided by 12, and that amount, that gross monthly amount, is what they're going to use in all of your calculations. So if your income was less in 2015 but more in 2016, then they're going to average it out. Okay? So that's not, like I said, it's not a problem for them when your income goes up. It's just that when it declines, there's some red flags going on. And I mean, they're obviously so. Like I said, this is a 30-year mortgage. So what can you do to prepare? As I mentioned, have your documentation ready from jump. We left a list here below of the things that you're going to need, but back it up even more. So they'll ask you for 30 days of paycheck stubs. They'll ask you for 2 years of tax returns. If you are one of those people who is a part-timer or a overtimer or a bonus person or commission, then have some documentation from the employer so they can submit all of that together. So once your employer or, loan officer has all of that documentation, they're going to automatically submit you through an automated underwriting system, and then they're going to back it up with this physical documentation that you're handing over to them. It's going to go to a processor, and eventually it's going to go to an underwriter. The underwriter is the one who really gives the final approval. They're looking at the information you submitted on your application and the information that was entered, data entry, into their automated underwriting system, and they're using your documentation to prove that everything that was entered is legit. Here, the underwriter is solely working on behalf of the lender. You will never speak to them, okay? And they're evaluating your risk, the risk of doing a loan for you. So the best advice I can give you is to prepare and overgive and to make sure you have your information on point beforehand. We're going to get into the other areas of the approval process, but as I mentioned, employment and income is more important than your credit. Okay, so I hear so many people, I want to buy a home. I need to get my credit together. Okay, is your income and your employment, and your employment together? That's the number one thing I want you to focus on. So if you have any questions, we are going to have a Q&A with a phenomenal loan officer, Ray Palmer, who's going to walk through some more in-depth questions, and I'll make sure to post a little graphic up so you can put your specific questions there, and we can cover it in a live Q&A. Okay, see you for day number 3.